So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, what happens when you buy a put option? So when you buy a put option contract, you are exchanging the money that you paid for the put option contract in exchange for the right, but not the obligation, to sell stock in the future at the strike price that you determined. So with a put option contract, you give somebody else money or capital, and that other person is the put option seller. And in exchange, you are buying a right from them. They have an obligation now to deliver the stock to you, to purchase stock from you, and you have a right to sell stock to them at a predetermined strike price in the future. And that's pretty much all that happens. So whenever you get into these long put option contracts now, you have the choice of whether you want to exercise your right or not. You can basically transfer your risk by getting out of the contract or removing the contract, buying it back or selling it back in the open market. Or you can choose to exercise that agreement with the put option seller and take delivery of short shares from them or sell shares that you have at a pre-existing price. Most people use put option contracts as a means to hedge long stock positions. So what somebody might do is that if they're long stock, they might buy a put option contract so that if the stock starts to go down, they've already basically predetermined their sale price with the put option seller, and they don't lose any additional money below that strike price. Now, again, this comes at a cost, and many times put option contracts tend to cost much more than call option contracts because stocks can and often do fall much more violently and in a much more bigger fashion than they do rise and rally. So generally we see put option premiums, or the premium that you pay to the option seller, to be a little bit more than the call side premium. So hopefully this helps out just with some general put option basics. But if you have any questions, as always, please let us know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.